Did you know that by 2025, global investments in green finance are expected to pass $1 trillion? That's right, $1 trillion going into renewable energy, clean tech, and companies trying to fight climate change. But here's the question. Is sustainable investing just a feel-good buzzword, or is it one of the smartest ways to grow your money in the future? In this video, I'm going to break down green and sustainable investing in a way that's super easy to understand. We'll cover ESG, green bonds, and climate tech, what they are, why they matter, and how you can start investing in them even with a small budget. So stick around because by the end, you'll know whether sustainable investing is something you should add to your portfolio. What is sustainable ESG investing? Let's start with the basics. When people say sustainable investing, the first term you'll usually hear is ESG. ESG stands for environmental, social, and governance. Think of it like a scorecard that rates how responsibly a company is run. The E looks at things like pollution, carbon emissions, and how much a company invests in renewable energy. The S focuses on social issues, how a company treats its employees, diversity, community impact. And the G is governance, basically how ethical and transparent the leadership is. Now, ESG investing isn't about charity. It's still about making money. But the idea is that companies that care about the environment, treat their workers fairly, and avoid shady practices tend to be more resilient over the long run. For example, a company with a huge carbon footprint might face fines, regulations, or bad PR that could hurt its stock price. On the flip side, a company investing in clean energy might benefit as governments push for sustainability. Here's the catch though. ESG isn't perfect. For example, Tesla was once considered the poster child for ESG because of electric cars. But later, some rating agencies downgraded them over workplace issues and corporate governance concerns. So the point is, ESG ratings can sometimes feel confusing or even contradictory. Not every green company is as sustainable as it claims, and not every polluter is excluded. That's why as an investor, you need to look deeper than just the ESG label. But don't worry, this isn't meant to scare you off. Instead, it's to show you that ESG is just the starting point, a lens to help you filter companies. And if ESG sounds a little too broad, there are more direct ways to invest in sustainability that tie your money to specific projects. That's where green bonds come in, and they're honestly one of the most underrated tools in investing right now. Green and sustainable investing. Alright, let's talk about green bonds, because this is where sustainability meets traditional finance in a really interesting way. So what exactly is a green bond? Think of it like this. When governments or companies need money for a big project, they issue a bond. A bond is an IOU. You lend them your money, and in return, they promise to pay you back with interest. Pretty standard, right? But here's the twist. With green bonds, the money raised has to be used for environmentally friendly projects. We're talking things like building wind farms, funding solar power plants, creating energy-efficient housing, or even financing electric public buses. One of the coolest things about green bonds is that they're not just theoretical. Real companies are using them. For example, Apple has issued billions of dollars in green bonds to help fund renewable energy in its global supply chain. That means if you, as an investor, put money into a green bond fund that holds Apple's bonds, your money is indirectly helping shift the tech industry toward cleaner energy. Now, here's why investors like green bonds. They're considered relatively safe. Because many of them are issued by governments or giant corporations, the risk of losing your money is lower compared to, say, betting on a risky startup. Plus, you get the added benefit of knowing your investment is making a positive environmental impact. It's like earning steady returns while also doing some good for the planet. But, and you know there's always a but in finance, green bonds have trade-offs. One downside is that their returns are usually a little lower compared to riskier investments like stocks. Think of them as more of a stable, long-term play. And there's also the issue of greenwashing. Some companies issue bonds that they label as green, but the actual projects aren't always as environmentally friendly as advertised. That's why it's important to stick with funds or issuers that are transparent about where the money is going. Here's the bottom line. If you're the kind of investor who values stability and wants your portfolio to reflect your values, green bonds are a great place to start. They may not make you rich overnight, but they give you peace of mind that your money is growing steadily while also helping fund real-world solutions to climate change. But what if you want to go beyond safety and chase high-growth opportunities in the sustainability space? That's where climate tech investing comes in, and it's honestly one of the most exciting areas in the market right now. Climate tech investing. Now let's talk about one of the most exciting and risky parts of sustainable investing: climate tech. If green bonds are the safe, steady choice, climate tech is the wild frontier with massive growth potential. So what exactly is climate tech? In simple terms, it's any technology that helps reduce greenhouse gas emissions or fights climate change. This includes renewable energy like solar and wind, but it also stretches into things like carbon capture technology, electric vehicles, alternative proteins, sustainable agriculture, and even smart grids that make our energy use more efficient. Here's why this space is exploding. Investors see climate change not just as an environmental issue, but as a massive economic opportunity. Think about it. As the world shifts away from fossil fuels, trillions of dollars will be redirected into new industries. Whoever leads the charge in clean energy, EVs, or carbon tech could become the next Apple or Amazon of the green era. Let's look at some examples. Rivian, the electric vehicle company, raised billions in funding and quickly became one of the most talked about IPOs in recent years. Beyond Meat created a whole new category with plant-based protein and proved that consumers are willing to pay for sustainable food alternatives. And startups like Carbon Clean are working on capturing carbon dioxide directly from the air, a technology that could change the course of the climate crisis if it scales up. Now, here's the reality check. Climate tech investing is not without risks. Many of these companies are still startups, which means they can be volatile. Stock prices can swing wildly, and plenty of them won't survive in the long run. Just like the early internet boom, some players will thrive, while others will crash and burn. That's why it's so important to diversify. Instead of betting all your money on one flashy climate tech stock, you can spread it out across multiple companies through a clean energy ETF or a climate tech-focused fund. But here's the exciting part. For younger investors especially, climate tech is a chance to be early in a megatrend. Imagine being an early investor in Amazon during the dot-com era. That's the kind of potential upside we're talking about here. And even if you're not chasing massive gains, putting a small portion of your portfolio into climate tech is a way to align your money with the future economy. So green bonds give you stability, and climate tech gives you growth potential. But how does this all fit together in your portfolio? Let's talk about why sustainable investing isn't just about values, it's about building long-term wealth. Why it matters for your portfolio. So why should you care about all this? Well, sustainable investing isn't just about saving the planet. It's about protecting your wealth and taking advantage of long-term trends. Studies have shown that ESG-focused funds often perform just as well or even better than traditional funds during downturns. Why? Because companies with strong governance and sustainable practices are usually more resilient in tough times. On top of that, younger investors, Gen Z and millennials, are driving demand for these kinds of investments. That means more money is flowing into ESG funds, green bonds, and climate tech every year. And when demand rises, so does value. But there's a catch. Greenwashing is real. Some companies exaggerate how green they are. That's why it's important to look beyond the labels and do a little research before investing. Gold. How to get started. So, how can you get started? You don't need thousands of dollars. You could begin by looking into ESG ETFs like the iShares ESG Aware ETF. If you want something steadier, explore green bond funds. And if you're interested in growth, check out clean energy or climate tech ETFs that spread your investment across multiple companies. Even starting with $20 or $50 a month builds the habit. At the end of the day, ESG gives you the framework, green bonds give you stability, and climate tech gives you high growth potential. The question isn't whether sustainable investing is the future, it's how early you want to be part of it. If this video helped you, hit the like button. Would you invest in climate tech Or do you prefer safer options like green bonds? I'd love to hear your take.